In this week's video, we'll review the latest and historical data to help us answer the question, will high stock valuations take down the bulls? Valuations are part of the weight of the evidence, and thus they can help us think in probabilities. Between March 23rd, the day the S&P 500 made the recent low, and April 6th, and in subsequent weeks, a mountain of evidence has accrued, helping us keep an open mind about better than expected outcomes. And as the S&P 500 moved off that March 23rd low, it would have been very, very easy and somewhat logical to ask during this entire move. That all sounds great, all of that bullish evidence, Chris, but what about valuations? We'll be reviewing two popular valuation metrics for the stock market. We'll start with PEs based on the trailing 12-month earnings for the S&P 500, and then we'll switch gears to the Shiller PE or the CAPE ratio. The recent stock market bottom was made in March of this year. Trailing earnings PE for the S&P 500 was hovering around 19, present day level 22 and change. Thus, it may be logical to ask and answer. The market bottoms with a PE of 19 and then rallies off of that low, and we have PEs ranging between 19 and 22. Is it possible, based on history, for the stock market to rally further? Now we're focusing on the lower left-hand corner of the screen. This is 1991. This is 1995. The readings shown on the screen here range between 19 and 26, which is similar to the present day. When the market rallied in this area here and had a PE of 19, in this case, really good things happened for a long period of time. With these valuations, the S&P 500 from this low tacked on 417% and rallied for several years. Since we just mentioned that the present-day PE is 22 and change, might be logical to ask. We have a 22 here, a 23. How did the market do walking forward from this point? As you can see, the answer is extremely well, 242% from these lows here. Any other periods? It's a longer-term chart, so it's a little bit difficult to see the volatility in this area here. Trailing 12-month PE for the S&P 500 ranged between 19 and 22 in here. Very, very similar to the present day, ranging between 19 and 22. How did the S&P 500 perform walking forward from this point here? It tacked on an additional 155%. How about these major lows here and here? As the S&P 500 was trying to make a bottom was made in October of 2002, and we have a retest spring of 2003. You can see PE ratios ranged between 29 and 38 relative to the one shown on the screen. And it's noteworthy that every single one of these levels in here is higher than this level, this level, this level, and this level. And yet, from this major low, good things happened for a long period of time. The S&P 500 gained 101%. And the rally lasted several years. How about the 2009 low? A period that we have covered numerous times in recent weeks. A lot of similarities between this period here and this period here. How do valuations look near this low? The numbers shown on the screen here range between 22 right here and 110 at the major low. If we took the average of these numbers in here, pretty fair to say it would be higher than the average of these numbers. And as we all know, in this case from this low, the S&P 500 did extremely well. Gained over 400% over the next decade or so. We've also covered the 2015-2016 case numerous times in recent weeks. And as you can see, PE ratios numerous times in this area look somewhat similar to the present day. And from this low here, the S&P 500 tacked on an additional 85%. That's in addition to anything in the rearview mirror. The purpose of the exercise is to help us answer the following question. Based on recent history, is it possible for the stock market to continue to rally, having a valuation profile like this following a major low. We've just pointed out numerous historical examples that say it is possible. Not forecasting anything here, just trying to understand probabilities based on present-day trailing S&P 500 PEs. Said another way, figures like this in the present day, are they a showstopper for the longer-term bullish case? The answer is no. Another popular valuation metric is the Shiller PE, or the CAPE ratio. CAPE stands for cyclically adjusted price-to-earnings ratio. When the S&P 500 bottomed, the CAPE ratio was hovering around 25. Now we're back up to 30. Asking and answering the same question, is it possible for the stock market to rally when it starts the rally with a valuation metric similar to 25? Here are some recent cases. CAPE, 25 right here, 30 and 31 here. Near this major low in 2002, we have a 28, a 26, a 25, a 26, and a 27. Walking forward from this point here, a 25, similar to the low here. The S&P 500 gained 155% over the next several years. Recent readings, 25, 26, 27. Readings in here, 25, 26, and 28. From this low, the S&P 500 gained 101% in the subsequent years. We're not forecasting anything here, just trying to understand what these numbers may or may not mean. Let's take a little bit more detailed look at the history of the Shiller PE and see what we can learn. Now we're switching back for the moment to standard trailing 12-month PE ratios. Remember, earlier in the video, we said trailing PEs for the S&P 500, and a trailing PE is based on actual reported earnings looking in the rearview mirror. Our range was 19 to 22, similar to valuations in this area here. Present day, 19 to 22. Same metric, 19 to 23. In here, my cursor here is 1991. This is 1990. Now, let's examine the same period here, but let's switch from trailing 12-month PE ratios back to CAPE. This is the S&P 500 here in 1990. We're going to correct. And while we're correcting, this is what we know from a CAPE perspective. Looking back to 1881, the average CAPE was 14.6. The median CAPE, 14.71. From a valuation perspective, there are some pros and cons to looking at averages and some pros and cons to looking at medians. We all know what a median tells us. A median basically tells us, based on history, there is an equal probability of falling above or below the median value. So when the S&P 500 starts to correct here and comes off of this low, this is what we know. We have no idea what the future looks like. So at this point here, and now we're looking at CAPE figures, 16 and 18. Right in here, we can only make decisions based on the data that we have in hand. Something that was true in this area here, and something that's true today. So as the market starts to move off of this low, right off the bat, it doesn't look particularly cheap. 16 is above 14.71, or the median value going back to 1881, and 18 is well above 14.71. Let's talk about this figure right in this box. 110 years of CAPE data told us in the 1990 and 1991 window that a reasonable expectation walking forward was for approximately 50% of future CAPE data to fall below the median CAPE ratio of 14.71, and conversely, about 50% of it should be above 14.71. Thus, right in here, it's possible we would have looked at the average CAPE of 14.6 and the median CAPE of 14.71 and said, I'm going to wait for a better entry point. I really don't want to invest when CAPE is at 16, and I'm really not interested when CAPE is at 18. And remember, from this point here, this is all we know. In the real world, between 1991 and April of 2000, the S&P 500 makes a major peak in March of 2000. What percentage of monthly CAPE readings fell below the known median CAPE ratio of 14.71? And we know if history is any guide, the answer should be somewhere in the neighborhood of 50%. The real answer? 0. Here's the area that we were talking about, and these are CAPE figures walking forward. We're answering 0 based on every single monthly data point, not just the one shown on the screen. The lowest number walking forward from this point here was in the 15s, above the median of 14.71 and above the average of 14.6. Our knowledge here and subsequent market action tells us unequivocally that CAPE figures, based on the past, cannot predict what investors will be willing to pay for a dollar's worth of earnings in the future. With this knowledge here in 1990 and 1991, it would have been very, very difficult to wrap your head around a move like this and a CAPE ratio of 44. So let's assume in here, with a CAPE of 18, we look at these figures, and this is all we know, and we say we're going to wait for a better entry point. That would have been unfortunate because from this low here, between 1991 and the spring of 2000, the S&P 500 tacked on an additional 417%. A fair and logical rebuttal might be, come on, Chris, both standard PEs and the Shiller PE/CAPE ratio expanded during the 1991 to 2000 period. But that's just one period. What about over longer periods of time? Have multiples expanded or basically stayed the same, or have they contracted? When we answer this question, if the answer is they basically stayed the same, then CAPE has been extremely useful. So to answer this question, in the upper right-hand corner of the screen, we looked at the average CAPE ratio between 1960 and 1979, 1980 and 1999, and 2000 to 2019. All three periods span 20 years. 1960 to 1979, 16.70. How about from 1980 to 1999? CAPE ratio expanded. In simple terms and for illustrative purposes, 1670 tells us that the average investor was willing to take out $16.70 out of their pocket to pay for $1 worth of S&P 500 earnings. In this 20-year period, for the same dollar, they were willing to pay more, 18.39. If we look at this 20-year period, do we look like this or this? The answer is we really don't look anything like this, and we really don't look anything like this. Therefore, if we were using this figure to try to figure out what was going to happen in this period, valuations got quite a bit higher in this period than they did in this period. And if we tried to use this figure to predict what was going to happen in this period, the future looked quite a bit different than the past, and the future here, this 20-year period, looks significantly different than this 20-year period. So back to the original question, have multiples expanded or basically stayed the same? Over the past 60 years, expanded. This is a 10.12% increase in the multiple from this 20-year period to this 20-year period. This is a 42% increase in the multiple between this 20-year period and this 20-year period. In 1979, we would have had no way of knowing that this is the average CAPE in this period here, and we would have had no way of knowing that this is what the CAPE ratio is going to look like in this 20-year period. This didn't necessarily predict this, and this didn't necessarily predict this. Before we walk through this, we're not trying to predict or forecast anything here. We're just trying to understand. In the future, is it possible that multiples could contract? Yes, it's possible. Is it possible that multiples could expand? Yes, it's possible. If the average CAPE between 2000 and 2019 increased by 10% as it did from this period to this period, hypothetically, it's possible that the next 20 years would see an average CAPE ratio of 20.75, higher than 26.11. If we assumed we had expansion, multiple expansion, somewhere between 10% and 42%, take the average of these two numbers, that's roughly 26%. 26% increase, this number here to this number here, takes us to about 33, telling us it's within the realm of historical possibility that the next 20 years could see the average CAPE look quite a bit higher than the last 20 years. And history tells us it's possible that the average CAPE can increase substantially, 42% from this period to this period. A 42% increase of this number here would hypothetically bring us to an average CAPE of 37.08. That sounds like a really big jump, but this is a really big jump in the real world. And in the 1999 to 2000 window, the highest CAPE reading that we saw was 44, substantially higher than the average CAPE ratio between 2000 and 2019. And if we assume, hypothetically, that the max CAPE in the future was 10% higher than this real-world number, that would take us to 48.4. You may be thinking, a move from 26.11 to 48.4 is a big increase. It is. It's an 85.37% increase. That is pretty big multiple expansion. And we've been in this business for a long, long time. And we would have no problem at all if somebody said an 85% increase between the current average CAPE and the hypothetical secular bull market max CAPE. That sounds insane. It does sound insane. Is it insane? History says no. Clients and regular viewers may remember this slide here from a past video on the Shiller PE. This sounds crazy. Well, in the real world, that number was much, much higher, 198%. The median Shiller PE at the end of 1982, going all the way back to 1881, was 14.83. We've already mentioned that the highest CAPE ratio, or Shiller PE, in the spring of 2000 was 44. A move from 14.83 to a max CAPE ratio of 44 is an increase much, much bigger than 85%, significantly bigger. If we take the known median Shiller PE, what we knew in 1982, it would have been nearly impossible to fathom that the peak Shiller PE in the subsequent secular bull market would represent a level that's 198% higher than what we knew in 1982. Telling us that all of this does sound insane, but history says it's well within the realm of possibility. And remember, you could say this is one of the biggest bubbles in history. Yes, that's true. In fact, 1980 to 1999 encompasses that big bubble. The average CAPE ratio was 18. So we're not being biased here. This is the bubble right here. It's still expanded in a period where the S&P 500 basically went sideways for 13 years, from the year 2000 to 2013. So significant expansion took place after this gigantic 18-year bull run here. Let's take a break from valuations for the moment and shift gears back to the present-day market. A week ago, in the Friday, June 12th video, we said, while last week was horrible, the S&P 500 a week ago today was down over 4% for the week. That's this big plunge here. But we did note, despite that plunge, there's a lot of evidence that said maybe it's not that bad, including the fact that the S&P 500 closed last week well above the 50% and 61.8% retracement. Intraday on Friday. This chart here is as of noon. This 80 points for the week is later in the afternoon before the close on Friday. The market has stayed above the 61.8% retracement and the 50% retracement and bounced back nicely as of Friday afternoon. The close to be determined. We covered this chart a week ago. It's a chart dated June 12th where we basically said this sell-off here really wasn't out of historical norms relative to 100% normal and to be expected drawdowns following similar 10-day breakaway momentum thrusts. It's very, very easy to look at bullish data and expect the stock market to be up every day, every week, every month, and every quarter. Even within the context of the strongest secular trend, it just doesn't work that way. It would be wonderful if it did. So a week later, Friday, June 12th, right around noon, we're still holding above these levels. And this is a good time to remind ourselves that having realistic expectations is extremely important under all circumstances. Realistic expectations walking forward with maximum flexibility. The market's moved a long way. Some type of drawdown or sideways consolidation would not be shocking at all. Even in one of these cases here, drawdown almost 11%. It would take us back to about 2,800 hypothetically in the present day. The look of this chart here tells us from a probability perspective, this really no longer looks like a counter trend move within the context of a downtrend. It looks more and more like a new sustainable bullish trend. If you know DeMark counts, they basically align with that as well. All four major DeMark counts, this 9 and 13, this solid line, has been negated from a probability perspective. That aligns with everything we just said about this chart. We'll be moving very, very quickly here. Feel free to use the pause button on your video player. Wall Street Journal. Investors are sitting on the biggest pile of cash ever. This is text taken directly from the article. Despite the big move off of the low, sentiment still far from irrationally exuberant. Pause your video player. You can pause your video player here. This is a blurb about recent hedge fund positioning, not necessarily current hedge fund positioning. We covered this chart, comes directly from the Bank of America Global Fund Manager Survey a few weeks ago. The message is basically the same. Overweights relative to history, all four of them defensive. The largest underweights relative to history, all 11 of them circled here in red, growth related. Think of that in the context of this, and all of this. You can pause your video player. Right side of the screen speaks to less bad. Mark's tweet here tells us that the general public's interest and concern related to the virus is waning. How could that possibly be with all of the negative press coverage? There are some data sets to be concerned about, and there's also a lot of very encouraging factual data that we have in hand. Here's a blurb from this Wall Street Journal opinion piece. At the close of the video, we will show more quotes from this opinion piece. Allowing you to read them, no commentary is necessary. Tweet on the right side of the screen. You can pause your video player. Less bad. What's the moral of the story here? Valuations are relevant. What you pay for something is always relevant. Valuations, including the Shiller PE, affectionately known as CAPE, it's helpful, it's useful. If we didn't think it was helpful and useful, we wouldn't be spending hours analyzing the data. Valuations help us better understand risk and reward and opportunity cost propositions. What do we mean by opportunity cost propositions? These figures here help us evaluate stocks relative to other alternatives, such as bonds and/or gold. Other key takeaways. Understanding that by some measures in the present day, stocks are expensive relative to historical norms. allows us to keep an open mind about worse than expected outcomes. It's hard to maintain maximum flexibility if you can't do this. And recent CAPE figures here, upper right-hand corner of the screen, relative to history, tell us it's prudent to have risk mitigation and portfolio migration strategies. What do we mean by portfolio migration? It's reducing your stock exposure and moving to more defensive assets. Examples: cash, bonds, gold, etc. How is all of this helpful? Understanding that A, multiples can expand over time, and B, stocks can remain overvalued for very long periods of time. All of that allows us to keep an open mind about better than expected outcomes over the next 1 to 5 years. Something that's very, very difficult to do if you believe the past will predict the future, and if you believe the past will predict the future. And we're not making that assumption. It says it right here. We're not assuming that multiples are going to go up or they're going to go down. If we respect all scenarios walking forward, it's much easier to interpret data in an unbiased manner. Would it have been helpful in one of the examples that we showed here to understand that multiples can expand over time and that stocks can remain overvalued for very long periods of time? Yes, in this window here, if we understood and respected A and B, it's possible we could have participated in some of these gains. And remember, when the CAPE ratio was 18 right here, this is all we know. We have no idea what the CAPE ratio is going to look like in the future. In this example, if we decided to wait for a better entry point, lower multiples, from this point down here, the stock market has never revisited this level down here. And at this point in 1991, given this 18, this 14, and this 14, it would have been very, very difficult if we didn't respect A and B to wrap our head around what the next 33 years might look like. This point here is this point here. This is the present day in the upper right-hand corner of the screen. So in that case, understanding and respecting A and B, was it helpful? Yes. It was not only helpful for the next 1 to 5 years, it was helpful for the next 33 years. And it's incredibly important to note, just like charts, indicators, and data sets, valuations cannot predict the future. All of this, charts, indicators, data sets, valuations, you name it, all they can do is help us assess the probability of good things happening relative to the probability of bad things happening. And regardless of what the data sets, charts, indicators, and valuations look like, the probability of bad things happening is never zero. So the key takeaways, A and B, and respecting the possibility of worse than expected outcomes with high valuations. We can handle all of it if we head into next week and every week using the basic concept of trading the chart in front of you. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice. and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.